course. All right, I'm talking to our guest. He's already raring to go. Let's take a look at the inflation numbers that just came out over the weekend in Nigeria. Yes, year-on-year inflation, 33.9. In fact, across the board, you can see the numbers yourself. There's been an increase year-on-year from April to May. Headline, food, core, urban, rural, it's all there. Now, if you take a look at month-on-month, though, and this is, well, yeah, that's the chart. So you can see the chart. We charted it out from the MBS. You can see that projection all the way from when President Tinubu came into office, May 2023, up until May 2024. Now, it's a different story with the month-on-month, and you can see, I think, save for, rural is the only metric there, subsector, which did increase. Yeah, everything else decelerated. I don't like to say came down. We just like to say decelerated. Where's the chart? We just put up the chart for month on month, and you can actually see it. We love charts because the chart actually shows you how the figures move. Okay, we hopefully should have the chart. We don't have it yet, but you can pretty much see that. All right, Victor Ndukauba, who is the Deputy Managing Director, Afrinvest West Africa Limited, joins us to discuss. Victor, thank you so much for joining us on a holiday. Happy Eid. Thanks for being with us.
Happy Eid as well.
So, using year-on-year first, what do you make of that continued increase in the trajectory?
Well, thank you, Rotus. Inflation is a difficult subject to discuss for obvious reasons. Unfortunately, the drivers of inflation continue to be negative. And so there's very little surprise to see that for the 17th consecutive month, it's been an increase. And what are they? Basically, energy prices. So we're talking petrol prices, diesel prices, electricity prices, and of course, FX. So when we look at it year on year, this time last year, where was the exchange rate? Where was diesel price? Where was petrol price? On all accounts, we can see that those prices have increased across the country, and that largely explains why we've seen the successive increase in inflation numbers.
Now, for the chart that we had there, where you saw that projection going up, for the average Nigerian, which is something we always have to ask about, this increase you're seeing here, we just talked about disposable income in our last segment. What does this mean for the disposable income of folks in the country?
Unfortunately, inflation is a thief of value. The sad reality is that high inflation essentially means worse. It means it spells it's a negative spell for the average Nigerian. What does it mean? In essence, the cost of living and cost of expenses continue to rise, and therefore it erodes purchasing power. At the current levels, we see a scenario where even though month on month the numbers are beginning to slow down, it means that the rate of increase is beginning to decline. Unfortunately, at the current levels, which is month on month, typically we would like to see something at 1% or less, for it to mean something sustainable. Otherwise, at the current levels, it means that people's purchasing power would erode by 50% within 2 years.
Okay, so as far as the divergence, if you want to call it that, is it just that you're seeing prices, decelerate for month on month compared to year on year? How would you explain the divergence between year on year climbing up and month decelerating?
So, I think it just looks at because it's a mathematical model, you're comparing two sets of numbers. So when you look at year on year, you're comparing where the CPI is today, versus where it was a year ago. However, on the month-on-month basis, you're looking at what it was last month versus this month. So on a year-on-year basis, the increases are essentially explained, like I cited earlier, on account of some of the very negative changes that have happened on the fiscals. The monthly decline, however, suggests that some of those factors are the impact of that is beginning to blunt. And so you're seeing that inflation, though increasing, is increasing at a slower pace. That's what it means when we look at it on a month-on-month. And to that point, I think our own models, for example, suggest that all things being equal, that inflation might peak this month in June and then begin to gradually decline starting in July.
That's year on year, though?
Yes.
Okay, fantastic. All right, I need that chart. We're going to get that chart up in a second, the month-on-month, just to show the movement. But I want to get to the latest Treasury bill auction that we saw. And if you look at, I guess, the 91-day, 182-day paper, the stop rates for each of them, we did see, I guess, a bit of the rates coming down. But my question was to you is, with the appreciation that we're seeing, okay, we'll have those T-bill rates, hopefully we'll get them up. But if the appreciation that we're seeing in inflation, will that mean that investors are going to demand more in terms of return? Okay, yes, there they are. We have them. So 91 days, 16.3. I think it was 5th of June or so, it was 16.5, 182, 17.4. So across the board, we're seeing the rates coming down. So investors are going to be demanding more as inflation keeps climbing.
Well, the answer to that is a yes. Investors typically would like as much as possible to earn a return that, at the very least, tries to beat inflation. Unfortunately, that isn't the reality. So from the numbers you've shown, we've seen what is effectively a negative return in real terms. So inflation continues to trend above 30%, well above 30. And so in terms of real returns, it's negative. So while investors obviously will want to bridge that gap, there is obviously the flip side to that, which is who is borrowing at this level? It's government, right? So 1 year at 20.5% means that effectively for the 6 trillion the Nigerian government plans to spend through borrowing this year, it would pay at least 1.2 trillion in interest expenses alone. Now, recall that on a 5-year average, the cost of funds to the government has been north of, in terms of expenditure to revenue, has been about 60% or more. So when we think about that fact and the fact that the averages were at a time when the cost of treasury bills issued by government in terms of return was around the sort of very early teens, 11, 12 at the very most. So now that we're at 20%, it means that there's going to be significant pressure on the government's expenses. So the incentive to want to offer more isn't there.
Gotcha.
The second factor is that a lot of the borrowings that the government wanted to do for 2024, it did it in Q1, front-loaded a lot of those borrowings, and so isn't under particular pressure to take as much. And therefore, the likelihood that they would want to offer more returns, or in terms of a higher return to investors, is not as robust. The flip side to that, obviously, is the private sector borrowings, which you've seen, become quite a thing in the CP market. But as you know...
Sorry, those have you asked commercial papers, right?
Commercial papers.
Technical folks.
Yes, so commercial papers, which are essentially private companies borrowing, those instruments are benchmarked on the treasury bills. What you're finding is that those ones also very aggressively uptrended. Now you have 270-day papers, yielding anywhere between 24 and potentially 30% in some cases. But that in itself also becomes a concern for many investors who feel, look, what nature of business can a company undertake to be able to borrow at such levels, make a profit, repay those loans, and still be able to run operationally, in a sort of fiscally balanced way. That concern means that we're beginning to see appetite also thin out on that side, meaning that treasury bills remain attractive to government.
And okay, I'm glad we got the month-on-month chart up, so at least our viewers could see the movement there. Okay, so yes, there it is. I'm addicted to charts. We have to show you.
It tells a story.
It's essential. Yeah, it tells the whole story. All right. So, what does on the equity side, for the equities market, what does the rise in rates? What does that mean? Is it bearish for equities?
It is indeed bearish. It's a logical consequence of what we're seeing in the fixed income market. Year to date, the market, even though it's positive, overall, we've seen that in the last 2-3 months, there's been massive sell-offs in equities. It's been largely bearish. It's a very bearish market. So on the one hand, obviously, this can be explained by the shift. The moment the central bank adjusted the MPR significantly, 600 basis points at the very least, and then by so doing, shifted yields on fixed income instruments, so treasury bills, and of course commercial paper, we've seen a flight to safety. So investors who have liquidity have opted to play it safe. And there's been an overweight by investors towards those short-term fixed income instruments. The other side to this conversation, obviously, is what is happening with companies and corporates generally in the economy. So we saw a lot of the results come through, for the telcos, the largest ones we've seen for the brewers, we've seen for banks. 2023 was challenged for many players on account of the FX movement and what it meant in terms of exchange losses. I think for MTN, for example, for the first time, hasn't paid a dividend on account of a huge loss that has basically wiped out its capital. So that factor where companies, the immediate past performance for last year and the outlook in the near term isn't exactly bullish has meant that that is a further dampener to equities vis-a-vis fixed income.
All right, so what do you think happens at the next MPC meeting? I mean, each time that Mr. Cardoso has sat with his team, he's dealt with inflation continuing to climb year on year, although he did point out the month-on-month deceleration. But what do you think happens? Do you think it hike rating?
I had earlier alluded to the fact that based on our own estimates, we think that inflation will peak in June and thereafter begin to decline in July. So we think, if our model is correct and there's aligns with ours, that they might stay action and may not shift.
So they might hold?
They might hold.
Gotcha. I want to bring in the States. This is something that a lot of folks don't really, I don't think anybody talks about the States, but we here on Arise News, we don't do what everybody else does. So I gotta get your thoughts here, because there's this minimum wage discussion that's going on. So so MBS, they do this all the time. So your highest rise, Bauchi, Kogi, and Oyo, 42, 39. This is headline. If we go to food, I think, this is month on month. So Kano, Gombe, Bauchi, that's what I'm focusing into the left of the screen for all our viewers, just for the highest rises there. You can see the slowest on the right. Then food, Kogi State, top 3 in headline, top in food. It's been that way. This is a state that is supposed to be the part of the breadbasket. Ekiti and Kwara. Today's front page of today's This Day newspaper and Nigerian newspaper of record talks about how they want organized labor. The government said labor should be take into account economic reality. So what do you think about the states and their respective metrics and how that feeds into the whole minimum wage discussion?
It's a very curious set of data points. Looking at it. First of all, a lot of the states you've seen there, registering extremely high, both year-on-year core inflation as well as food inflation. Like you alluded to, our bread baskets, they're known for agriculture and significant crop output. To see them clock such high inflation numbers is a big concern. Top of my head, again, we haven't done a lot of work, to be fair, in trying to understand what is driving this behavior or the returns we're seeing, the numbers we're seeing, the metrics. But my sense is that a couple of things obviously could be linked to this. I think perhaps if we looked at some of the highest adjustments in energy prices, I do recall that, for example, Kano had a very sharp spike in petrol prices, where we saw petrol sell, as high as 2,000 at some point, just about 2 months ago. And that clearly would have had an impact in those places month on month, especially looking at the numbers on a month-on-month basis. Some of the other issues are around insecurity. Kogi, I know, for 2 key reasons. One has been the parlor state of infrastructure. The road into and out of Kogi has been pretty bad, and it's been on the radar for a lot of kidnappings. So I do suspect that perhaps food is grown, but the insecurity that has been associated with that state might have meant that the cost of moving food produce in and out of Kogi might explain why we're seeing such high numbers. For so many of the other states, the numbers are sort of all over the place. You really quite can't tell. But I think, generally speaking, bringing the conversation back to the question of minimum wage and the discussions, where the organized labor and working with the organized private sector is trying to negotiate what would be a new baseline for the country and all actors in the economy. It's a very, very nuanced conversation, to be fair. It's one that I feel requires a bit of introspection. As a country, we've got to look at our structure as a federation and decide, do we set a uniform benchmark for every state, or do we allow states essentially pay what they can afford? Because it's one thing to set a benchmark, another thing is essentially willingness and capacity to pay. That's a big question. And I think to the extent that the living conditions and the reality in terms of just living standards across the country not being uniform would then, to me, suggest that perhaps there is a basis or an argument to be made there about, sort of having this thing stagger across the country.
pressing issue. It is still top of the top of discussions for everybody around. So we have to, of course, ask analysts, executives like yourself for their thoughts. Victor Ndukauba, who of course is the Deputy Managing Director, Afrinvest West Africa Limited. Thank you so much for talking to us about inflation, minimum wage, all the pressing issues in Nigeria. We appreciate your time.